How would you like to trade options with a 98% probability of profit? Well, in today's video, I'm going to break down a trade that I placed a few days ago, which actually has a 98% probability of making money. If you would like to increase the number of winners in your trading, I strongly encourage you subscribe and hit the bell notification as I break down a number of my trades absolutely free on this YouTube channel to help you make better trading decisions. And make sure you watch this video to the very end, as I'll show you how I manage this position to virtually guarantee a profit. So what is this high probability options trading strategy? Well, it's a put ratio spread. A put ratio spread is a bullish to neutral strategy where you buy and sell a number of out the money puts. An example ratio would be 3-to-1. This means you would buy one out the money put and sell three out the money puts. I generally create a put ratio which creates a net credit upon trade entry. Here is a put ratio spread trade I recently placed on Apple. This trade has a 3-to-1 ratio where I sold $300 strike puts for a credit of 77 cents each, which equates to $2.31 credit. I also bought the $110 strike put, which cost me $1.72. Therefore, if you net out the 231 minus the 172, that generated me 59 cents or $59 upon trade entry. The expiration of this spread is 17th of February, which is 51 days away. Now let's break down this trade and visualize what happens if the stock moves up or down. So we're here on optionstrat.com, one of the best free tools to visualize or building option trading strategies. And if you guys want this, it's absolutely free. The link is down below. So I've built the scenario of the trade that I've done, and I'll just walk you through what I've done here. So again, we're looking at Apple currently at $126, and it's down 2.71% on the day, which is quite a big move to the downside for Apple. So we've got the February 17th expiration, and I have created my put ratio spread. So we sold $300 puts, and we have purchased $110 put. Now that is my 3-to-1 ratio, and that gives me this situation over here. So you'll see here, firstly, that the net credit is slightly higher than the $59 that I got filled at. This is the same day, but an hour later. I probably should have waited an hour, only because Apple started to do a massive down move just after I entered. It's always the way it works. It's just after you place the trade kind of goes against you. So we could have picked up a better credit. The max loss is technically an undefined risk trade strategy. However, this doesn't really bother me because there's ways to manage this position to not get anywhere near that. In terms of the maximum profit, you can actually make over $1,000 with this particular strategy, and chances of profit you need to have the paid version for. I'll show you the screenshot inside my brokerage app so you can see that 98% chance of profit. And our break even point, so where we actually start losing money, is if Apple drops below a 94.58. That's a 25% move from the current price today. So that's why we have a high probability of profit, because Apple, in my opinion, will go down in 2023. I don't think it will drop by 25% by February the 17th. And even if it does, I actually make more money when Apple actually starts going down, as we'll look at in a second. So that's the setup for the trade. That's how it looks on OptionStrat. And again, you can visualize the P&L at any point in the expiration cycle. So I've done it right at expiration. When we talk about managing this trade, which we'll go through near the end, so make sure you stay so you understand how I'm going to manage this position. This is just what the theoretical what it would look like if we held this option all the way to expiration. So the first scenario is what happens if the stock goes up. And this is why I mentioned before is I always like to receive a net credit, because if for whatever reason Apple starts going up, the maximum I can gain is the net credit received. So it will be the $59 in my case, or the $84 in this particular example if we were to place the trade now. And that's why you want to create a put ratio spread that gives you a net credit. So if we change this, for example, to we only bought 2 contracts, you can see here that we're paying $21. So if Apple goes up above the stock price, we're actually losing $21. So you could say that this is a scratch trade where you actually want Apple to actually continue to go down. My view is I don't really care what happens to Apple. Ideally, I just want to make money. So worst case, if Apple goes up, which I don't think it will, I think it will go down, I will make $59 or $84 in this particular example. So anywhere above the current price, we'll make $84. And we start making money when more than the $84 when we start to breach our short put option, so the $110. And the reason why this is because our 110 put option that we bought will be in the money. So this option price will start to increase in value. And so we'll start to increase in value as it goes in the money. So will our 3 puts we sold at 100. They will also increase in value. However, they will not increase in value at the same rate as this 110 put. And this is kind of seen here. So again, remember, this is at the day of expiration. So our max profit is the 1,084. And this point here is at the $100 put strike. So if we think about it, this put option at the day of expiration will be worth 0 at $100 or $101.11, as you can see here, right? So this will be out the money and this will be in the money. Because this option will be in the money, this will be worth more, a lot more than this. So as time goes on, or as we get closer to this, this will decay in value. So we want this option to be basically 0 at the day of expiration and this to be the most as possible. So that is the peak there. Our best case scenario to achieve max profit is $100. Now, this is what I love about this strategy when it comes to a break-even perspective. So your break-even is the width of your put strike, your buy put strike, and your sell put strike minus your credit received. So in this example, it's $10.84, which you can see here is your break even will be $94.58. So mine's going to be slightly higher than that by about $20 odd, so it'll be $94.70 odd something because I received less credit. But that means that, again, like I mentioned, Apple has to drop 25% at the date of expiration. So this is why you've got a massive range to kind of work with. So Apple can go down, right? Apple can get all the way here. We actually start making a lot more money when Apple starts hitting, going below 110. And I call this kind of like a hedging mechanism strategy where you are technically selling puts, but you bought this protection or a hedging mechanism here, which is why I love this strategy. So here is the screenshot of this particular Apple combo spread trade. And as you can see, the probability of profit is 98%. This is one of my highest high probability winning trades that I put on all the time. I'm going to be sharing more and more videos with this type of strategy. You can also see, again, like we showed before, the max return is 1,075 with the break even of 94.62. Again, slightly less than what you saw, or slightly more, than what you saw on option strat, because we brought in less premium. And the margin impact is only $80 to place this trade, which is absolutely insane. So depending on where I take my profit, whether it's between the 10 and 30%, I'm going to make a good amount of return based on the efficiency of capital I've deployed on this particular trade. So make sure that, again, you comment down below if you've got any questions, and also make sure you watch this next video that goes into about my earnings trading strategy, selling short strangles, which is another options trading strategy. And I should see you guys in that video.